So we're going to kick off this conversation with a look at crude oil, because crude oil was very much the catalyst for a lot of the price action that we saw today in the equity indices. And the reason for that is, remember, the market is always bouncing two ideas around: known versus unknown. Known versus unknown. What was unknown today? What the initial claims number would be. What was known? That the initial claims number would be released. What was known today? That we knew the initial claims number was another record 6.6 million as opposed to 3.2 that we got last week. What was unknown is that we would get the president calling up CNBC to mention that he had been on the phone with Putin and that Putin had been on the phone with MBS. And punchline, he said, we're expecting a 10 to 15 million barrel per day production cut. Boom, that sent crude oil higher. Now, for those of you that were in the room with me, probably a lot of you remember Salty Roggy coming out and saying, what the heck? Not but just yesterday were we talking about a market that rallied when the buildup was higher. In other words, when we had a inventory build in crude. Well, that kind of made sense. I had to let go the irrationality of that, but that kind of made sense because not but a few days ago, the general public, the U.S. public, was told, hey, that price you're paying at the pump due to historic production, due to that production making its way to refineries, giving you at the pump very low prices in crude, was akin to a tax cut. All right, well, I can understand that. I can get behind that. And then what happened is when we had the build, people thought, great, even lower prices in crude and even lower prices in RBOB, which is the RB futures contract. Now, I'm even more bearish RB or the UGA ETF. I'm even more bearish that than I am crude, because all the overproduction, let's call it what it is, all the overproduction in crude is going to be peddled off to refineries. Refineries are going to be making unleaded at breakneck speed, and that unleaded is going to find its way to us at the pump. It's going to find its way to, crude is the king of commodities. There is not a single commodity out there that at some stage of its planting, harvesting, growth, transportation doesn't involve petrol, right? There's no such thing as any commodity that somehow completely circumvents. And I mean commodity as in the grocery store to the world, not the financial instruments, not the currencies, not those things. I'm talking your grains and your softs and your meats, etc., right? Your grocery store commodities. Nothing can work around the fact that at some stage, the machinery that either moves it, harvests it, plants it, transports it, is going to require crude oil, right? Okay, so that's why I call it the king of commodities. The king of commodities simultaneously is under pressure in three ways, really. A planned and expected drop in demand that we were warned about throughout 2019. Clearly, right, the coronavirus, and a very strong U.S. dollar. Strong dollar typically means weak commodities. So that's another sort of force keeping pressure on commodities. All right. So what do I want to do with crude? Now, I don't ever want to confuse politics with trading. Stan Druckenmiller talked quite a bit about how many of his peers, and we're talking people moving around billions of dollars, how many of his peers got caught up in the politics of 2016, who was in the White House and what it meant, and they forgot how to play the market. They got very emotionally tied up. And that reminded me of something I've always known. Don't get caught up in the emotion of politics. It doesn't pay. Unless you're a political pundit on one of the cable networks, you're not going to get paid for your opinion. And I'm going to tell you something right now. Nobody cares. Not about mine, not about yours. The market certainly doesn't care either. Right? So having said that, I'm going to put something else out there, right? Not to tick anybody off. I could care less about the politics of it, but we know that, well, our president is prone to some hyperbole and some supposition. Let's use that word. He is prone to that. This is not news to anybody. So the crude oil market rallies up on the expectation that this conversation is in fact, well, something that led the president to believe that a 10 to 15 million barrel cut was really in the works. And the market responded to that. Okay? Responded to that supposition. It was just a logical, to the speaker's mind, it was a logical flow of where the oil production was going to go. And then almost magically, the market just remembered exactly what I just told you guys and said, wait a minute, let's think about the source here. And the fact that, again, I'm not here to talk politics. What I'm here to say is there's a kind of natural expectation right now when certain political leaders speak. I guess we could chalk that up to all of them, right? I'm not picking on any one. And all of a sudden we said, well, is Putin really going to do it? Is MBS really committed? And did our president really hear it right? And then boom, you saw the pullback. I think if we get confirmation of this 10 to 15 million barrel production cut, if we get it, and we're already hearing that OPEC, the Saudis want to, and this is where some of this is factually probably starting, the Saudis want an emergency meeting. We have one more thing, one more hurdle that we have to get through, and that is let's get the official number. Let's get the official agreement of who's on board. Is the U.S. shale, is the U.S. shale producers, which by the way are the ones that are overproducing the most, okay? They have to. You have to produce a lot of crude when your cost per barrel is extremely high, and that's where shale is. Shale is the most vulnerable. Next most vulnerable are the Saudis, least vulnerable are the Russians. So if we get one more spike higher, gang, this is where we as traders, we let go of all the chit chat, all the narrative and say, less demand. Production cuts are not demand. Less demand, let's short the 21 exponential moving average. Okay? Now that's probably a really long story for me to tell you that we want to short the 21 exponential moving average, but you have to kind of know why, because the timing of all these players is going to likely be what will sort of dovetail with the technicals, okay? So again, I'm not here to turn anybody off. I could care less about politics. What I am here to acknowledge is that there are certain people that are going to move the market. We saw that clearly here today. Okay, so then today's crude oil production cut expectation also took the equities markets higher. Now, in just yesterday's premium video, I said, look, if you did not get your short at the 21 exponential moving average prop dot, 21 EMA prop dot on ES, if you did not get your short on the 21 EMA prop dot on the YM, if you did not get your short on the NQ at the wave, I don't think those opportunities are necessarily done. And how come I can't pull up YM? Let's try this again. Incorrect symbol. That's not true. Okay, hang on one sec. And actually, while I'm trying to put this chart together, it probably would behoove me to tell you guys a little bit more about what's on it. So let's do that for just a moment as I'm sort of putting this back together again. Hopefully it's... All right, there we go. All right, what do I have on this chart? So let me show you here. What am I running on it? I want to run the propulsion dots, the grab, the wave. These are free tools within the TradeStation trading app store. They're free tools that I make available by way of the Think scripts for Thinkorswim. These are free tools within TradingView. The tools that are not free are the squeeze and the, let me add them here so you could see them. The squeeze is not free. There we go. The V profile and the V score are not free, and the VWAP is not. Another question that I get is, Rock, how do you do that overlapping thing with the squeeze? I modify the squeeze, by the way, just to give me the dots. And then what you can do is put it in you can share the subgraph. You can share the subgraph. So you put them in the same subgraph and boom, you end up with this sort of combination of the V squeeze, if you will. All right, for those of you that use the squeeze and the V score. That way you're not taking up valuable real estate at the bottom of your screen. Okay, so let's get on back to crude. We talked about that. Hopefully that's loading up well. Okay, so the 21 exponential, by the way, crude oil is a 21 exponential prop dot short. The S&P is a 21 exponential prop dot short. The Dow, the YM, is a 21 exponential prop dot short. Now, for those who are saying, Rog, I'm new, what the heck's a prop dot? This is the simpler trading propulsion. Think of it, and this is a unique tool. This is a tool that replaces nearly all the exponential moving averages on my chart. It's free. It's free for TOS. It's free for TradeStation. It's free on TradingView. I think we have versions of it that are floating around in Ninja. I don't use Ninja. We have versions of it on, I believe, the AT charts through Infinity as well as the Sierra. Okay, so this is a free tool. I've made this free since I taught the class back in 2017, I believe it was, or 16 even. Anyway, what this is a measurement of two exponential moving averages. It's taking a moving average cross, the 8 diving through the 21, and it's plotting where the longer of the two moving averages would be. So if you had a 21 EMA on your chart, you only want it to turn on in a trending environment. You really only want it to turn on when it's interacting with price in a what I feel a predictable and useful way. So this is what simpler propulsion does. It takes into advantage that very classic moving average cross, a short moving average diving down through a longer one, and then it replaces the moving average with kind of what I consider to be a smart or auto-correcting, self-correcting EMA. It's very cool. Give it a whirl. That's where I'm looking to enter this trade at the 21 exponential. Now, on the Dow, that 21 EMA has stopped plotting. So it's probably going to make sense for me to also consider the 34 EMA on the low, which is exactly also where the NASDAQ short will fire off. Now, some of these longer term setups, whether that be the NASDAQ, the S&P, the Dow, copper, gold, these are setups that I have and will continue to send out as alerts. Yes, I want to alert you guys when I do it, but even more so than that, it's really important to me that I alert these things sometimes hours, if not days in advance, so you have this on your watch list. You're well familiar with the charts. You're very familiar with the setup. And then when it happens, it isn't like something like a knee-jerk reaction where you're scrambling to get into the trade. You're able to calmly, collectively say, yeah, I knew this was coming, and I know exactly what my reaction level is. When it fires off, I've got an alert waiting there, and I know what I need to do. I've decided to either trade the option, I've decided to trade a micro, I've decided to trade a mini, what have you, at that level. So I never want you guys sort of knee-jerk trading. I like to give you all as much heads up as possible, because that's when you get to make the alert a study, and you learn something from it, so it too can become a repeating process for you. Okay? So copper's out there, 21 exponential. Dow's out there, 34 EMA on the high. NASDAQ is out there also as another short, 34 EMA. So did I say on the high, 34 EMA on the low, the red line. So when you don't have the dots, so we have the dots on the S&P. I believe we still do. Let me double check. Oh, we might have just lost them too. When you don't have the dots, what does that tell you? The 21 EMA is shut off. So we probably need to focus on 2648, 2650 for the ES. Some of you say, Rod, can we really get up there? Let me ask you something. Does this market want to rally? I'm not sure that it wants to rally, but I sure know that it's being coaxed. It's being convinced that it's not time to sell off yet. So we focus on the top and bottom of the range. Very important distinction with the way that I trade. Our shorts are up here. They are not, I repeat, they are not down here. Okay? So we want to focus on the top, what I call the top of the range. I know this is not a unique name, but that's what it is. It's the top of the range. This is pure support and resistance, gang. What is support? What is resistance? All right? So let's do this. This is resistance. This is support. This is the top. This is the bottom. That's simple. Right? So we look at the ranges and we say, where do we have an advantage to being short? Where's my best risk reward? Up at the top of the range. Where do I have the best opportunity for a buy? Quite frankly, gang, I think that buy is probably pretty consistently right now at the bottom part of the range. All right? So until that low here around 26 24.26 gets taken out, until we can start running stops really through 24.20, very unlikely that the bears are going to be in control. Very unlikely. So that's something else I want to, make sure I'm really emphasizing here. So I sent out some alerts for gold. I sent some out alerts for copper. Gold took off. It did, and we were looking for 1575 yesterday for the trigger in order to buy GLD. Am I going to do it again? Absolutely. There are two zones for us as a trigger to buy GLD. And one of the things that I want to do tomorrow with you all into the close is talk about these contingent order type placements that specifically you can do on Thinkorswim. Most of our membership is in Thinkorswim. So I'll talk about how to place that kind of option on Thinkorswim. All right. Okay, so next is looking at so you talked about copper, we talked about gold. A lot of questions about bonds. Do I want to be long bonds? Does anyone here think interest rates are going to go up anytime soon? The only thing that I'm lacking on the bonds, whether that be the 30-year, whether that be the 10-year, whether that be the 5, what I'm lacking is a pullback. We need a pullback. Is the Federal Reserve buying all ends of the yield curve? Yes, it isn't just a longer end any longer. They're trying to also keep the yield. I mean, they were doing this a while back. They figured, well, if we buy across the entire yield curve, we can sort of eliminate the inversion, right? And they're trying to do that, but too late. It's already double inverted. A single inverted yield curve is not a high predictor of recession. It's the retest. We talk about retests a lot, don't we? It's the retest of the yield curve that's actually the trigger for the recession. And even then, if you want to look at it, subsequent trigger for weakness. And we did have that re-trigger, that retest. So they can do whatever they want across the yield curve. We're quickly heading to where the U.S. government is going to be the largest holder of treasuries, of U.S. treasuries, just like the Japanese government is the largest holder of Japanese government bonds. So they own the most JGBs. Look, we're heading in the same direction. You might ask, where does that actually eventually go? I think gold is the beneficiary of that. If you kind of take that narrative from a macroeconomic perspective and look at the dominoes falling, I think the winner, longer term, of course, but longer term, the winner does end up being gold. I do believe that. So we're long dollars, we're long bonds, and we're going to continue to look for opportunities to get long gold. Not a new narrative for us at all. In the meanwhile, our long dollar play against the Australian dollar and our long dollar play against the British pound are both pretty much on track. The British pound has taken its time. It's spinning its wheels here, but it's spinning its wheels below our entry. Look, I don't mind a lethargic P&L, but it's a whole lot easier to sit through when it's green than when it's red, right? So Australian dollar has been terrific. Sell Aussie, buy US dollars. The question then becomes, well, why not euro, Raghi? For a couple weeks now, and I know those of you that are with me, yeah, this is going to move from time to time. But how many traders did this thing punish when the dollar weakened? So one of the things we have to remember is the trends in the dollar's strength are right now playing out better against the Australian dollar, New Zealand dollar, Canadian dollar, and pound. Yes, there will be certain days that will look great for the euro, but we're better off right now day trading that until the euro US comes up with better structure. And that brings us another related topic. That brings up, can we short Canadian dollar? If the Canadian dollar is going to strengthen with this crude oil narrative, I do want to take advantage of the Canadian dollar going up with this high tide of crude oil. And then the same time that I'm likely going to be looking at a CL short, we'll take a look at a 6C short. We'll short that Canadian dollar against the US dollar. That's another narrative that I absolutely want to take advantage of and add this in a more meaningful way to our short in terms of against the dollar specifically. All right, so crude oil, RBOB gas, and the Canadian dollar are all in the same wavelength. And we can add to that the EWC. So if EWC heads up, to the 21 EMA prop dot like we talked about there, we're going to take a look, and we discussed today the 22 strike puts on the June contract. The 22 strike puts. It's the second largest, I believe, on the options chain. The first largest is the 24. 24 strikes have 9,000 open interest. 22 strikes have 5,000. I want to take advantage, and they're very inexpensive. For those of you wondering, Rob, how expensive is this? It's actually very inexpensive. We're talking about $1.85 to $3.30 options. And I'm purposely talking about the bid on this because the bid is the side of the market that we're most interested in. We want to enter these puts with bullish momentum, and we're going to have a much easier time getting a fill at or closer to the side of the spread at the bid. There is right now a, 60-cent spread. Am I going to pay up and pay the ask at 245? Heck no. I'll sit in down at 185, 190, 195, $2. That's fine. Edge towards the side of the bid, and you will get that fill more often than not when the momentum is going up and you want to buy a put. All right? When you want to buy a put. So when we're talking about intraday versus end of day trades, we're going to wrap up our conversation here, gang. End of day versus intraday trades. When it's a daily time frame or a non-day trade, when it's a day trade, I'll put in day trade, and those are just good for the day. Just let those cancel. But if it's not a day trade, I will put the trades in good till cancel. I will do GTC. And we'll do some special breakout sessions on order entry here going forward, because I know a lot of new traders are interested in, okay, Rog, I don't quite understand what you mean by the bid-ask spread on the options. I don't quite know when I should be end of day versus good till cancel. And we'll do that throughout the month of April for sure. All right, so this has gone on a little bit longer in terms of a premium video, but I know a lot of you have a lot of questions, and I hope this absolutely helped. So that's going to round out our premium video, and I'll see you in the next update.